A new wave of money printing is here. We're about to see a ton of liquidity enter the market as the Trump tax cut and spending bill was signed into law on July 4th. And remember when the market was tanking at the beginning of the year and Scott Bessent and Trump were saying that short-term pain is ahead, we don't care about the stock market. They were trying to lower rates. And what did I say at that time? I said, wait for signaling from the White House to tell you that they are done with the tariff talk. They are done with trying to lower yields, and they are going to move on to money printing. Well, this is that time.
The stock market's at an all-time high. Jobs are at an all-time high. Everything's at an all-time high, and we're going to keep it that way.
So not only are they now paying attention to what's going on with the stock market, but they pushed the tariff deadline once again from July 9th to August 1st, kicking the can down the road. Now, Elon Musk is fuming, saying that he's going to start a new political party. So here's everything that you need to know in the stock market this week. And then I'm going to get into the charts and see if there are any money-making opportunities for us to leverage in the short to mid-term. Let's go. So these tax cuts are way bigger than the tax cuts that we had in 2017. And that one really propelled the market forward for another 3 years after that was signed. But this one is even more aggressive. So not only does it extend the tax cuts that were initially made in 2017, but on top of that, we have a new wave of tax cuts that we've never really seen in the US before. Tax relief for tipped and overtime workers. This is no tax on tips, no tax on overtime. It increases the standard deduction all across the board. Even the SALT deduction for state and local taxes goes up significantly from, I think, $10,000 to $40,000, and no tax on Social Security benefits. So this right here is our total public debt. The United States debt is $36 trillion. Does this mean that the US owes $36 trillion? Yes, because these are all the treasuries that the US issued. When you buy treasuries from the United States government, they're obligated to pay you back with interest. So this is what the debt is currently. We have borrowed $36 trillion and we owe interest on $36 trillion. So you could see here this big jump around COVID, and then it just accelerated from there, and we just signed a new tax bill that will likely add $4 trillion to this right here over the next 10 years. Now, I'm going to talk about the charts later, but the last time this happened, the market rallied 30% over the next 2 years before the pandemic dropped. Now, here's why Elon is going crazy, and I actually agree with him here, right? He tore his hair out in order to try to save as much money as possible with the Doge initiative because he really thought that the Doge initiative was something that the president was actually serious about and would consider doing in a serious manner. The president then turns around and says, as every president does, this is not just Trump, every president wants a spending spree on their dime because that's how we grow the economy. And then everyone can say, wow, this president really added this many jobs, really grew the economy, etc. And that's all and well if we weren't doing it by adding a ton of money to the national debt. So I'm actually curious here as to how much the GDP has to grow every single year in order to offset the additional debt that is caused by this spending bill. Let's see. How much does the GDP have to grow every year to offset the additional debt caused by the big, beautiful bill? To offset the deficit increase from the one big beautiful bill over the next 10 years, U.S. nominal GDP would need to grow by approximately 4.3% to 7% per year, depending on the deficit estimate, whether you estimate it as adding 2.77 trillion to the deficit on the low end or 5.2 trillion to the deficit on the high end. This is how much the GDP needs to grow every year for the next 10 years. Now, in terms of nominal GDP, the US has actually grown by 4% or more most of the time per year. But if we're talking about real GDP, when was the last time real GDP grew by 4%? So aside from the post-pandemic recovery, which obviously was due to a lot of money printing, the last time real GDP grew by 4% was in the year 2000. So make of that what you will. So because of his frustration with the money printing that this is going to generate, Elon has decided to form a new political party, the America Party. Now, third-party candidates haven't fared very well in this country, even when they were super rich, like Ross Perot. I remember that back in the 90s. I was a little kid. And even Trump came out and said that third parties have never succeeded in the United States. The system seems not designed for them. So what does this mean for Tesla here? I don't really know. Like, are they just completely sick of the Trump-Elon beef? It seemed like it last week, as it moved the needle way less than it did back in early June. And now that the 7,500 EV credit is set to expire September 30th, 2025, and it's not going to renew, it wasn't in the big, beautiful bill. If that happens, are we going to see a wave of buyers rushing to buy EVs? And the best-selling EV in the United States is Tesla. Are they going to be rushing to buy cars in order to gain that 7,500 tax credit and beat the expiration date? Maybe. Now, in other news, we have the Fed meeting on July 30th, and it is expected that the Fed is not going to touch rates, especially as the unemployment rate came in at 4.1% last week versus an expected 4.3%. So job numbers, the unemployment rate actually went down, didn't even come in as expected. And because of that, you could see that the opportunity for a cut, or the chance of a cut, completely dropped from being 19% just a week ago to now being just 4%. So the Fed is likely going to stay put in July, and the first cut is not projected until September 17th, 2025. All right, let's get into the charts as the market continues to make all-time high after all-time high. In terms of some seasonality here for you, in the last 15 years, July has been the most green month in the stock market. As a matter of fact, in the last 15 years, July hasn't had a red month. And not only that, but historically, July is the best performing month that is not November, which is when we have the start of the holidays and the euphoria from the holiday shopping, etc. July is the second best month in the stock market. Now, August and September is when we likely tend to see slowdowns, and more on that later, because I think that we will follow a similar path here, and I do think we will see a violent correction down, and I'll go into what I mean by that. But it will definitely be an opportunity that you do not want to miss. Why? Because if you go back to World War II, when we are midway through the year and we've had a 5 to 10% gain, which has happened now, we just hit halfway through the year. The final 6 months are mostly green, and the full year return are 100% green, except for in 2011 we had 0%, so not red. And not only is the full year return green, but it's green by double digits, which means there's money to be made if we maneuver properly. Now, I have no reason to believe that the July trend is not going to continue, even though this looks crazy here, and we are definitely oversold by every metric, likely due for a pullback. But I still think I have no reason to believe that July is not going to be another green month. Obviously, nothing is guaranteed. It can be a red month, but I'm leaning towards data here. I have no reason to believe that July is not going to be a green month, especially because of the enthusiasm surrounding the big, beautiful bill. However, we are starting to see some overheating signals here. The National Association of Active Investment Managers, NAAIM, you could see the index here. This has really been reliable, even for short-term corrections. If you look just in recent history, if you remember last year, the big drop in August, you could see that here. This is in the March timeframe, right before the April drop. And you can see that we are getting a similar signal here. Now, it doesn't mean that it has to drop immediately. It can spend a little bit of time here, kind of like it did last year a couple of times. And if we take a look at the put-call ratio, the put-call ratio here is actually at an outlier low. Now, you might be saying to yourself, well, if the put-call ratio is low, that means there's less puts than calls. Yes, that typically means that when investors get complacent, or when traders get complacent on either side, either when they buy too many puts, you tend to see a short squeeze, and that's when the put-call ratio drops and the stock market rallies, or when the put-call ratio bottoms, that is when the stock market is usually high and you tend to see a correction down. But like I said, with the NAAIM index, this can spend a few weeks here. Now, here's when the last tax bill was signed in 2017. You can see that the market rallied for another month and a half before we had a straight crash. Now, even though we rallied in a similar fashion before the bill was signed, I still think that, as I said, I have no reason to believe that July is going to be a red month, but I do think that we see a sharp correction thereafter. People that don't remember 2018, it actually was almost a bear market. And we famously have these unfilled gaps here. There's one from April 22nd to 23rd. There's one from May 9th to May 12th. And then there's one here from June 23rd to June 24th. So just from today's prices, that first gap would be down about 4%. The next gap would be down almost 10%. And that third gap will be down 15%. There is this misconception that all gaps get filled, and that's not true. Most gaps do, but not all gaps. So I'm not saying that we do have to fill this one down here. But in my opinion, whatever drop we get, whatever correction we get, for sure is a buying opportunity, because these returns don't take into account a buy the dip situation. When you see these returns are from current prices. So allow me to illustrate this here just really quickly and easily. If we rally from here and say that, towards the end of the year, the expected rally is an additional 6% based on the data here. The average return is 6% when this happens. Yeah, if we rally 6%, and by the way, this is close to my 6,700 target on the S&P. But if we rally 6%, sure, it's nice. You're going to be making 6%. But say we drop that 9% in a sharp correction and then rally that 6% from current prices. Well, you're going to be up 17% as opposed to 6%. This is why our portfolios continue to hit all-time high after all-time high, because of all the buying that we did here. And I gave you these buys on this channel as well. But this is why I say that it is imperative to buy the dip when given the chance, especially if we can time it around some of these the seasonal data and what we know about the charts, and marry it with some of the breadth data that keeps coming in regarding the stock market and what happens when the stock market behaves like this. So right now, I'm not advocating for shorting the market, not after the big, beautiful bill is passed, not the fact that we're in July. For sure, in my opinion, do what you like, but in my opinion, don't short the market, right? You're going to make much more money if this opportunity comes and you leverage it properly than you would trying to short the market here. And while I am bullish for the coming year, what happens beyond Q2 of 2026, it's very hard to be bullish when your valuations look like this. Now, although I expect earnings to grow, especially now that we have a new injection of liquidity into the market, we are still at crazy valuation. Not only that, but unemployment has started to curve up. And although I know the last unemployment report was great, we are starting to curve up. You could see it here very clearly. And this has preceded every recession. Not only that, but you guys know about the 10-year and 3-month yield curve as well. Once this completely uninverts, we get closer to recession territory. Now, this can take months, and I am bullish for the rest of the year, but it's very hard, in my opinion, to invest heavy with these types of valuations. So in the midterm, we have to pick our spots very carefully here. And you want to find stocks that are laggards, that haven't caught up yet, that have a narrative that might allow them to catch up. I've talked about Apple. We played the breakout here, up tremendously on these leaps. But Google is another one, right? Google's another one that has yet to catch up, but it looks like it's forming a nice bullish trend line with higher lows and higher highs. Same with AMD, which is one that I initially got into as a swing trade, but the more I looked into it, the more news stories that came out about its new chip, the more attractive it looked. Also, I went and looked at what its price earnings growth ratio is. And if you take a look here, if you're not familiar with PEG, it's price earnings growth, right? Based on expected earnings in the future. And if you take a look at AMD, right now its PEG is currently trading at 0.75. If you compare that even to some of the laggards like Apple, Apple's PEG for 5 years is at 2, and NVIDIA's PEG is at 2 as well. So there is some catching up to do there with AMD, especially if what it says with regards to its new chips and the inferencing of its new chips, if it is able to grab some of that NVIDIA market share and it is expected to grow earnings in the next 5 years, we can definitely see the price start to trade in order to get similar PEG numbers from some of the other tech stocks. I also talked about the chip material stocks. These are lagging behind, but perfect trend lines here. You can see Applied Materials. Perfect trend line going all the way back to 2015. ASML is another one with a perfect trend line here. And this one goes all the way back to 2002. IWM, which is the Russell 2000. This is another one that I gave you guys back in April and May. And I said, if the big, beautiful bill is signed, expect small caps to get back to all-time highs. So right now, IWM is trading at 223. I definitely expect it to get to that 245 all-time high. As a result of this, you can see the bullish inverse head and shoulders here. But if you want my honest opinion, because I'll always be honest with you guys, if you have not invested here, this is not the time to start pulling the trigger. And if you are considering investing here and you've been watching my videos this whole time and you wanted to pull the trigger here, but you were too scared and now you're thinking about pulling the trigger here, that is just FOMO. That's not an informed decision, right? There's no way that you can mimic the gains of someone who pulled the trigger here if you buy here. And sure, you might be fine in 20 years, but you might experience some next level hurt in the short term. You are much better off, in my opinion. You could do what you like, right? But I think you are much better off waiting for a pullback in August and September before trying to go all in here. Now, I did say that there are some stocks that have opportunities, but you can see those are few and far in between at this stage, I'll be honest with you. But just imagine if we do get a 5 to 10% drop, how juicy some of these stocks that you've wanted to pick up, how juicy those prices will be. I also expect Amazon, by the way, to get to all-time highs relatively quickly as well. Now, I do day trade every day. I day trade futures and I sometimes day trade options, but I for sure swing trade options. If you want access to all of my plays, link is in the description below. If you want to watch me trade live and you want to learn from somebody trading live, in my opinion, there's no better way to learn than watching someone actually execute and open orders in front of you. There's no way that somebody trading live can hide. You're seeing them execute orders, entering and exiting. So if you want to trade live with me every day, remember that there's investing and there's trading. And while we certainly do have a long-term investing tier in the academy, which is perfectly fine, and if you want to learn how to be involved in the markets on a more active basis, then definitely check out the trading tier. If all you care about is long-term analysis and long-term picks, then check out the investing tier, which is a third of the price of the trading tier. Now, I get this question a lot, right? If I buy the investing tier, will you tell me when to sell? No, if you're investing, you shouldn't be thinking about selling. The only time that you sell when you invest is when you fundamentally feel differently about a stock. If you're trying to sell in time, downturns, etc., you should learn how to trade, which is a very tough skill, right? But you need to learn how to trade if that's what you're trying to do. If you're buying something for the long term, why would you sell it because August is statistically a weak month? That doesn't make sense, right? So when you sell something that you invest in, you're selling it either because you want to reduce your exposure, right? Like if you bought too much Tesla and now it went from 10% to 20% of your portfolio, you might want to reduce some of that exposure. Or if you no longer believe in the fundamentals of the company, you might say, I don't like where the company's headed. I'm going to sell my stake and rotate into something else. But trying to buy and sell while investing, no, you're just trying to act like a trader without actually putting in the time it takes to be a trader, which takes a crap ton of time. Neither approach is wrong, whether you want to trade or invest or both. We do it all. So come be a part of the group, subscribe to the channel, hit that notification bell, stay safe out there, traders. Peace.